Good day, ladies and gentlemen, and thank you for joining us today for this session where we're going to talk about structured products and the current economic situation that we face around the world. My name is Eric Olwagen. I head up distribution for international personal banking, and I'm joining you from South Africa today, and we hope you're going to enjoy this session with us today. So just want to touch on our agenda, and at the same time I will be introducing our presenters today. So firstly, we're going to start off with a macroeconomic update from Daniel Silke. Daniel is one of South Africa's leading political economy analysts. He's the director of the Political Futures Consultancy based in Cape Town and specializes in both South African and international politics, as well as the macroeconomic environment. Daniel consults widely to blue-chip clients, both in South Africa and globally, and is a regular commentator for both TV and radio. Daniel also joins us from South Africa, so welcome to you, Daniel. Daniel will then pass the virtual podium to Chris Berry, who heads up structured products for Standard Bank. Chris's team focus on wealth preservation products, and he's a member of the bank's Investment Oversight Committee. Having worked in the investment industry for 20 years, Chris has an in-depth experience of developing products which meets clients' wealth preservation objectives, as well as delivering bespoke, tailored solutions. He joined Standard Bank in 2010 and is a Chartered Fellow of the Chartered Institute for Securities and Investments, as well as a Chartered Management Accountant. Chris is joining us from the Isle of Jersey today. Welcome to you as well, Chris. So just a couple of housekeeping items. You will see a question and answer functionality. Please feel free to post any questions. We will spend a little bit of time after the presentations and answer a few of those questions. Don't worry if we don't get to your questions. We will, a few days after this event, share a recording of the presentation and also answer some of those questions we did not get to. So firstly, we're going to quickly look at a short video clip, and then we will go straight over to Daniel. So thank you, and hope you're going to enjoy the session with us.
Many of us can't think of anything better than putting 2021 behind us, and for many good reasons. Once again, we lost more than we expected to. Again, we had to fight harder than we wanted to. And we saw things we wish we hadn't had to.
The Pandora Papers show how the ultra-rich and powerful move their money around the globe.
But as with everything, there are more sides than just the downside.
The quartz looks like Cookie Monster. Look at that.
I'm here live. I'm not a cat.
We also watched in wonder as life took the lead. And we saw triumphs of will.
The Ugandan president gave out 3 expensive cars to 3 Ugandan Olympic medalists.
Some were triumphs of perspective.
I, Joseph Robinette Biden Jr., do solemnly swear.
And we experienced things we've never seen before, but always hoped we would.
South Africa's top court has sentenced the former president, Jacob Zuma, to 15 months in jail.
We will not be sending any diplomatic representation to the Beijing Olympic Paralympic Games.
Heck, through it all, we got things done.
This is the first flight we've ever completed on another planet.
5 penalties.
Because, my friends, that's what we do. As a species, as individuals, and as an organization. That's what we're about, and what we'll continue to do in 22. So, look ahead to events that will shake us, the moments that will wake us.
Newly elected sole mayor Osehu.
After this, 2 other expeditions will be carried out.
And the new celebrations that will make us better. It's in the nuances that the truth lies, neither good nor bad. It's what we choose to see that will define who we will be. So look ahead, chests out, heads high, because the future we want starts tomorrow. And if we work hard enough for it, it can be.
Well, very good morning, everybody, and greetings from Cape Town. A pleasure to be with Standard Bank this morning, and in particular, I'm delighted to present to you a macro overview of some of the key economic and a few political pointers as well as where we are, both globally and in South Africa. So sit back and relax if you can, and enjoy something stronger if coffee may not get you through the next little while or so with me. Firstly, let me just say that I seem to recall being at a New Year's Eve party just before the dawn of 2020, and my wife said to me at the time, 2020's got such a nice ring to it. And I said, yes, it does have a nice ring to it. But somehow I'm not sure if any of us would have been prepared for the monumental events that we've witnessed just over the course of the last 24 months or so. And sometimes you've got to pinch yourself that it's real, the social distancing from that once-in-a-lifetime pandemic that we are still largely living through, hopefully moving towards something more endemic than pandemic. We've lived through remarkable events in Washington just over a year ago, threats to the US democratic system, which may continue to unfold over this year and perhaps even into future years as well, with profound implications, not just for the US, but for the Western world as well. We witnessed just in the middle of last year the rather ungracious departure from Afghanistan of the United States and other Western forces, again, perhaps setting the scene for military conflict today, or for potentially a weakening of the role of the West in the world. And one can philosophize about all of these issues from a geopolitical point of view. And of course, we also continue to witness, and in a very serious way, climate change and the potential of a climate crisis really engulfing this world. I mean, all of these issues enough to indicate the volatility and difficulty with which we really now have to embrace and work with the 20s. And if that wasn't enough, everybody, if it wasn't enough, we have perhaps the most profound event that has occurred just in the last few weeks, the Russian invasion of Ukraine. And I'll come back to that in a moment. So, it is a substantial collection of events, many of them, I think, highly challenging, within, I might add, the context of remarkable scientific advancement, given the vaccine rollout, which I think has helped the world move through this pandemic itself. And when you look at that vaccine rollout and the advances of science in particular, before Ukraine, and I stress this again, before Ukraine, analysts were saying, well, are we perhaps going to repeat the period in the world economy, certainly, which equates to that post-Spanish flu period after 1920? Will we simply see a roaring 20s back again in the world as the pandemic moves through? And perhaps just over a year ago, when Joe Biden became president, he certainly had a broad smile on his face there, not so happy anymore. But the US economy, prior to Ukraine, certainly had bounced back. It had bounced back largely to 2019 levels, and in fact was showing better performance than the other Western peers, certainly marginally better than the United Kingdom, certainly than Japan, and broadly speaking better than the European economy as well. And the US had deep pockets, and they were able to plow back some of that cash into the pockets of US citizens. That helped consumerism, certainly over the course of that COVID-strained period, the last 24 months. But the reality, of course, of the macroeconomic view of the world is that the recovery, whilst it's been pretty good, and you could have made a lot of money being correctly invested, certainly in the FTSE or in the Nasdaq or in the S&P, it's been an uneven global recovery. The advanced economies of this world have done exceptionally well, but of course, emerging economies have done substantially less so well. They don't have the deep pockets, and they also don't have the ability largely to structure their own finances with the strength that, of course, the Western world has. So the world, of course, looks at a differentiated recovery, whether you are in the emerging market segment of the world or whether you are in advanced economies. The common, I suppose, threat is advancing global debt, and that global debt, someone's going to have to pay for COVID, someone's going to have to pay for other issues as well, and the future increase in defense spending coming out of the Ukraine crisis is going to add to global debt, not diminish it. But nevertheless, we go into a world in which global debt, as a result certainly of COVID payments, will be with us for some time, and future generations are going to pay for this, whether it's through increased taxes, direct or indirect taxes, or through other financial mechanisms. Before COVID, though, we saw the aftermath of, before the Ukraine, we saw the aftermath of COVID filter through into financial markets, particularly in terms of rising inflation. Consumer inflation was on the rise before Ukraine across all of the major economies as indicated on your screen, and frankly, for that matter, whether you, again, were in the developed or developing world as well. And as a result, we had, before Ukraine, the prediction of at least 4 US Fed interest rate increases, with the potential perhaps for even more, 7, it may be argued, over the course of the next year. All of this pre-Ukraine. And all of these issues relating to increasing inflation in the United States, interest rate rises in the United States, have led to the smile being wiped off the face of President Biden as he looks and stares down his rather lackluster popularity rankings, which can affect the Democrats in their upcoming midterms towards the end of the year. If there's one thing the Americans don't like, it's rising interest rates, and in particular, rising gas prices. And this was before Ukraine. So you can imagine the concern in the United States now, just politically, should the US end or at least contribute to a reduction in the reliance upon Russian oil gas exports. So the idea that we were going to have a roaring 20s, perhaps I might add, has turned into something of a raging hangover rather than a roaring party for that matter. And that hangover has been exacerbated by events just over the course of this last 2-week period, the last 12, 13 days in Ukraine. And I think this will illustration really, it kind of illustrates the position quite clearly as to where Russia finds herself in the world today. Yes, at the beginning of the invasion, staring down the Ukraine, a relatively small country, but not clearly that small, because the alliance that has been built up against the Russian invasion really has emboldened the Ukraine, and for that matter has substantially weakened Russia as well. You could argue that Russia already was a weakening superpower, but certainly I think the sanctions that we have seen imposed upon Moscow will have an effect of further weakening Russia into the future. These are just some of the logos of companies that have just disinvested, at least, or temporarily suspended their involvement in Russia right now. It is a remarkable collection of corporates that have done so. And it certainly indicates a very important shift in the world, where the Russian conventional attack on the Ukraine has been met with an economic response coming largely from the Western world itself and from some emerging market nations as well. And again, you can simply see the effect on the Russian currency, that collapse of the ruble that collapses literally as we speak. Rather interesting that economic warfare now meets the conventional. And the question has to be asked, at what point does Russia say, well, if you introduce economic measures against us akin to military measures, at what point do we view that as akin or necessary for some sort of military response, or certainly for an economic response coming from Russia? Of course, the background for the Russian-Ukraine conflict and the instability and volatility that it creates is predicated upon the fact that Russia still has about 6,000 nuclear warheads, not all of them active, but nevertheless, in real terms, even more warheads than the United States. If this had been a conflict between two nations without nuclear warheads, clearly the world would have been in a different place. But the world may well be in a different place in future as we contemplate further risk going forward. The potential certainly of Russia, and to some degree China as well, to redraft the rules of the game, to change the institutional balance in the world, that post-Second World War balance that largely gave power to the NATO alliance and to the United States. And this may well be the first salvo of an attempt by certainly Russia, and perhaps in future by China as well, to redraw and redraft the international order and the rules of the game. And what we don't know at this stage is how long this conflict, certainly this conflict in Central Europe, is going to last, and to what degree other countries in the region are going to be drawn in to this conflict, making it potentially a lot bigger than just a Russia-Ukraine battle going forward. And I think, from an investment point of view, clearly, whatever the outcome, and the outcome is very uncertain here, assuming Vladimir Putin survives in office, assuming he survives, even in a negotiated settlement around the Ukraine, which doesn't look that likely at the moment, but here's the best case scenario. He survives, there's a negotiated settlement, and Ukraine ultimately becomes partially divided, much like Cyprus was divided into a Turkish or Greek side. The West will still have to deal with Vladimir Putin. And by and large, the trust deficit between the West and Putin will have been absolutely nullified entirely by this action, leaving us with the potential for a second Cold War and a further era of containment, the containment of further expansion of Russia, perhaps into the Baltics, Estonia, Latvia, Lithuania, perhaps into Moldova, perhaps into Georgia and elsewhere. And many of those non-aligned countries are going to seek to become members of NATO. So the costs to the West are going to increase dramatically. The costs in raising military expenditure in particular, and when you have to administer costs to the military, you crowd out expenditure in, of course, other key sectors of your economy. Well, talk about crowding out other elements of expenditure. This increase in commodity and oil prices that we've seen is causing a major domino and ripple effect across the world. Now, before Ukraine, the post-COVID environment saw that our world was largely being shaped by the supply of commodities. There was a shortage of supply as the global economy revived in that V-shaped recovery post-COVID. And ultimately, we have entered an era in the world where supply constraints are the driving force of inflation rather than excess demand. Yes, there was excess demand after factories reopened after COVID, but getting supply, and to this I include now getting supply of critical assets like oil and other critical minerals, certainly from Central and Eastern Europe, that's going to increase inflation as supply shortages take root. This clearly will bring substantially more macro volatility and force all of us and policymakers to live with higher inflation. And again, before Ukraine, higher inflation was the order of the day, particularly energy inflation, already 27% higher in the EU before the Ukraine invasion. So with that invasion, we've seen, of course, a spike, broadly speaking, across most commodities, and a substantial spike at that. And we've seen the price of oil increase, touching rather close to the ominous $140 a barrel mark. Quite remarkable when you look at the lows, by the way, during that early part of COVID, where oil was just below $20 per barrel. Clearly, the implications for all of us are profound, whether you live in South Africa, whether you live globally as well. The rise in oil prices can simply raise inflation, certainly delay the peak for US inflation that was expected to taper off towards the second half of this year. And of course, that does provide profound political challenges for Joe Biden going into his midterms. From a global perspective, though, we also see that different countries are going to have different exposures to the Russia-Ukraine crisis. Now, on the chart on the left, you'll see the trade exposure of selected countries to Russia. And in particular, if we look at the Western world, Italy, Germany, the UK to some degree, France, Japan, the US to a much lesser degree, all have substantial trade exposure to Russia. But on the right-hand side of the chart, we look at the dependence on Russian fuel imports, and you can see large parts of Europe, in particular Italy, Germany, France, the UK, have substantial dependence on Russian fuel imports. A lot of Russian fuel goes to China, but about 40% of Russian fuel exports come in to Western or EU-based countries. And if indeed sanctions had to extend to the reduction of reliance upon Russian gases and fuels into Europe, you are looking at substantial disruption to the European economies in particular. It's not just oil that's critical. Clearly, in this particular chart, you can see the critical exports from Russia and the Ukraine. When it comes to food, wheat and maize are exports from both Russia and Ukraine and potentially liable to be disrupted. The price of palladium has rocketed in the last few days. The price of copper rocketed as well. The price of nickel, as you can see, Russia holds the lion's share there, certainly of nickel production. Wood, aluminum, and fertilizers all contribute to rising costs globally. And again, the price increases have been dramatic. And these price increases are not just issues relating to what's on my chart. I mean, you look at the price of wheat and you look at the price of corn on this chart, you don't have to be a genius to figure out that once this is factored into global inflation, particularly food inflation, you are potentially fueling food insecurity, particularly in poorer parts of the world, and may I say also here in South Africa as well. So I think that there are a number of different scenarios for analyzing the economic impact of the Ukraine crisis. I'm not going to go through all of the text in this particular chart, but I want to highlight to you the fact that the key issue right now as we sit here is whether Russian gas exports are going to be reduced as part of an increased sanction regime coming from the United States and Western Europe. And it does look as if this conflict continues and that the shelling of civilians continue from the Russian side, that the West will take action against Russian exports. And the irony, of course, is that the more Russia continues to export oil and gas, the more income she derives from the West to fuel the war in the Ukraine. So the moral imperative clearly is very substantial to reduce the reliance on Russian oil and gas, but the cost, the inflationary cost to the domestic economies, certainly in Europe, have political implications. And there has to be buy-in clearly across the board from a variety of political players going forward. From an equity point of view, again, murky and unclear. If you look at that black line there, this is the S&P 500 that's already substantially off the boil, you might say in a bear market already. And we can look at that in terms of the NASDAQ as well and the Dow as well. But just on the S&P 500, the scenarios are many and varied. I think that on the blue scenario there, which shows an uptick and a better equity performance, that is based upon a de-escalation of the conflict, not something we are looking at right now. The beige line indicates an uncertainty around the conflict that can continue for some months, if not years to come. And you're looking at a relatively flat and uninspiring equity performance going forward. And scenario 3, which is a further escalation of the Russian-Ukraine conflict, certainly looks as though at the moment, potentially, that is the one that I would probably err on the side of being a little more ready to predict, I might add, that can cause further instability, certainly in equity markets going forward. So a very murky and unclear picture. From a broader macroeconomic perspective, we are now looking at the potential of slower global growth and heightened inflation, meaning the return of stagflation that usually indicates a reduction in global demand and potentially also can reignite recessionary fears, all, of course, against the backdrop of this rising oil and commodity price going forward. So if the world's got troubles, as you can see, so as our President Cyril Ramaphosa here in South Africa in this rather pensive picture that I put up on the screen. It's been a very, very tough 4 years for Ramaphosa in office. And, there's a fair amount of political courage for Ramaphosa just domestically. I sometimes feel as though these global issues are much bigger even than South Africa. And for once, perhaps they are. But certainly for us in this country, the South African domestic position is critical to your savings and to your return on investment. It's now very much married part and parcel, not just with our domestic story here in South Africa, but with many of these international trends that I've mentioned as well. Politically in South Africa, certainly Ramaphosa, I think, has succeeded, at least in part, in slowing the patronage network that was endemic within South Africa under the Jacob Zuma presidency. And we've seen, I think, impressive strides, certainly on paper, and on paper in those 3 tomes that have come out of the Commission of Inquiry, the Zondo Commission into State Capture itself. But for Cyril Ramaphosa, when you are a reformer, and I might criticize him, but I still regard him as a reformer, when you are a reformer, you are susceptible, of course, to factional tensions, especially from factions who fear that their patronage networks will be disrupted and they might face judicial consequences into the future. Those factional tensions affect every aspect of South Africa's body politic today. And because the state in South Africa has been so intertwined with the governing party, with the ANC, the conflation of party and state, as we academics call it, almost every aspect of state functionality has also suffered as a result of ANC factions. So our South African economy well below 2019 levels. We haven't got to the position of the US or the UK or the EU creeping back to those pre-2019 levels. And I think it's just worth noting from National Treasury, where these figures come from, that our GDP projections, certainly for the course of the next few years, are relatively low. Our Treasury finally understands the fact that you can't just make predictions that look marvelous for the next 3 years. You've got to be realistic, and kudos to them for doing that. 2.1% GDP growth, real GDP growth projected this year, not bounce effect, real growth, 1.6% only for next year as well. The South African economy, therefore, not firing on all cylinders for obvious reasons, and the Ukraine issue itself is going to contribute to that misfiring. And again, I want to just highlight to you the projections for the South African economy here based upon various scenarios of increase in energy prices. Our GDP Treasury said that we would have a 1.7% GDP for this year. If energy prices increase 20%, which is the first column, we are likely to see 0.3% shaved off that 1.6%. And similarly, if energy prices increase by 40%, which is perfectly feasible on the basis of current geopolitical tensions, we could see up to a 0.7% reduction in our GDP, taking us to 1% or lower, clearly insufficient and putting substantial pressure on the ability of the government to try and resurrect this economy. Is South Africa a country, therefore, that is particularly at risk when it comes to these being buffeted by commodity prices? In some cases, yes, we have a weak debt position in South Africa, or one would say a rising debt position as well. We've got a degree of policy confusion. We've got the potential for higher inflation here. And as you can see on this chart, produced by Oxford Economics, South Africa is regarded in the top quadrant there of potentially greater risk economies. We're not Turkey, we're not Argentina or Egypt or Brazil, but we're not far off for that matter as well. From an economic point of view, of course, the big threat to South Africa, other than inflation and other than the limits that puts on our economic recovery, the big threat is our failure of good policy making to kickstart employment within South Africa. And again, you can see here, the unemployment rate in South Africa, the expanded definition now over 47%, that clearly indicates a failure of policy from the government side and a potential, of course, for social unrest going forward. In order to stave off social unrest within South Africa and to keep large portions of our population locked in, perhaps even politically, to the governing party, one of the success stories of this country has been South Africa's social income grants that has shown a 6-fold increase since 1998. But you've got to pay for this, and you've got to continue to pay for this, and possibly even expand this in terms of a basic income grant, and you can only do that in a growing economy, which we are not. Our GDP per capita has fallen behind the average for many of our upper middle income peers. We ultimately have become poorer. We think, of course, that we've had something of a windfall as presented in our budget a few weeks ago. Yes, we had a huge injection of nearly 200 billion rand as a result of commodity receipts, thanks again to the post-COVID commodity boom. And ironically, of course, this could be extended for South Africa as a result of the Ukraine invasion. There's going to be additional demand for South African coal as well, much maligned coal, by the way, but there's going to be increasing demand, especially if Russian gas supplies are limited into Western Europe. So South Africa really could see this windfall extended somewhat unexpectedly or so. But it doesn't get away from the fact that we have rising debt costs, which are now at 330 billion rand per annum. That's just our debt service costs in South Africa. That's bigger than the budget for many of our crucial departments within South Africa. And the big conundrum of whether government can cut its own expenditure, particularly when it comes to its bureaucracy and public service wage bills, it's going to have to be cut if we are to manage the debt increases that I've spoken to you about. All the more difficult to cut public service wages when you've got a rising oil price. eating into the take-home wages of so many civil servants. What a difficult period all in all. It's difficult domestically because the more South Africans feel alienated, the more they are susceptible to violence on the ground. Politically, of course, the issue will be on the shoulders of this man, of President Ramaphosa. Can he ultimately hold the ANC together whilst also trying to navigate new policy paths for his party? Well, he's got his biggest challenge yet, not just on the economy, but on the performance of his own party. The ANC suffering the worst performance yet for the party in local government elections. And I was part of a think tank exercise looking at the 2024 election, where the consensus view, certainly a few weeks ago, was that the ANC could very well drop to below 50%. It would be an historic moment for the Liberation Party not to have an outright majority, and new coalitions might well be needed, also creating tension within our society. Phew. If that's all not enough, the ideological framework that the ANC operates in simply has to change to create jobs, to provide growth, and to assist in shoring up the support for the ANC. And to his credit, President Ramaphosa has taken a stand. He's taken a stand by calling for greater cooperation between the state and the private sector and acknowledging that it's the private sector that creates most of the jobs, not the state sector. But ultimately, my friends, the state sector has to deregulate our economy to enable the private sector to be a real equal participant in all of these areas, when it comes to sustainable power, when it comes to red tape, when it comes to our transportation services, our internet and electronic spectrum. All of these issues require the state to relinquish some of its heavy-handed control to get us back into the pound seats if they are. So I think that from a South African perspective, we kind of at a turn, we're at a corner. The indications are not clear enough yet that prosperity is just around one of these two corners. And I think the illustration does provide it very, very aptly. So ultimately, whether you're looking from a global perspective or whether you're looking at a South African perspective, to me, this is a time to proceed with some caution, perhaps extreme caution, as you navigate the financial markets. And looking for, I think, new products, and in particularly structured products in this environment, I think becomes even more important as part of a portfolio diversification, particularly if it's a diversification into foreign currency or outside of South African rands. Thanks very, very much for your attention during this presentation, and I'm going to hand over now to Chris Berry from the Structural Products Department.
Thank you for that, Daniel. I think that was a great overview, really interesting overview of where we stand in the markets today in these troubling times. And we're really lucky to have people like Daniel who we can call on to help us guide through where markets might be taking us over the coming years. So on the back of that, I want to just provide a very brief overview of how we're helping our clients navigate these markets, given these difficult times. And the challenge from many investors right now is trying to retain the buying power of their investments, but at the same time without taking those undue risks. And quite frankly, this is getting increasingly difficult to achieve as inflation is going up and volatility in the world stock markets, as Daniel has just described, is also very high. And this leaves people really in a difficult position. And if you just leave cash in a bank account, well, those returns won't keep up with inflation, and the buying power of those funds is going to go down. But if you put them in direct equity assets, then obviously you need to be comfortable that you're going to take a risk on those investments. And that's not something that all investors are willing to do. So what we do with our structured product in Standard Bank is to try and address this by combining two things. We're trying to combine capital protection along with returns linked to how equity markets perform. So then at least investors are given the opportunity to keep up with inflation, given favorable markets, whilst reducing that risk on the investment compared to standard equity investments. And the first solution I want to talk to you about is the ESG index-linked deposit. This is a solution which links the returns to an equity stock market index
which considers environmental, societal, and governance factors in its formulation. The ESG as a movement has become a huge movement over the last few years across the investment community. I'm sure many of you will have come across it. According to Morningstar in 2021 alone, $500 billion flowed into ESG integrated funds. So that contributed to a 55% growth in assets under management for ESG products. So this really is a theme which is set to continue, especially as moves to combat climate change accelerate. But what is ESG? If you were banding around the term ESG, what does it actually mean? Well, it's over three things: environmental, social, and governance factors. The environmental factors will include things like how a company contributes to climate change, its policies on pollution, waste, its impact on natural resources or energy efficiency. Social factors can include human rights, labor standards in the supply chain, for example, diversity, and very topically right now also includes factors such as filtering out companies who derive revenue from controversial weapons such as cluster weapons. And then the G stands for governance. So governance factors can include basically good corporate behavior. So good corporate governance, transparency in their dealings, etc. They really are just factors that good, well-run companies ought to be taking into account in any case. Now, for this particular product, we link the returns to an index, and that index is called the S&P 500 ESG Index. It's a very straightforward index. It's actually a subset of the S&P 500 index. The S&P 500 being one of the largest US stock market indices, very broad base of companies. Now, companies are excluded from that if they trade in a number of industries, including tobacco or controversial weapons. They're also excluded if they're in the bottom 5% of a United Nations ESG score. And this index then selects 100 companies from within that index that demonstrate the best ESG factors, whilst at the same time trying to replicate the performance of the S&P 500. So what does the product itself actually look like? Well, the ESG Index Linked Deposit Issue 4. Now, I talked about capital protection earlier, and importantly, this product does provide 100% capital protection when held to maturity. So your funds invested are kept safe. It's based in US dollars and provides a return linked to 100% of the growth in that underlying index over a 5.5-year term of the product, excluding any dividends paid. The maximum total return being capped at 20%, so that's equivalent to around 3.35% interest rate in US dollars at the top end. So I think a relatively simple product, 100% capital protection, 100% of the growth capped at 20% overall. Simple product, and one that provides depositors with that security along with the market growth potential. The second solution is one actually that we've offered from Standard International for more than a decade now, actually. And it continues to be just as popular now as it was when it launched. And the reason for that is simple. It's a simple product combining capital protection along with returns linked to stock market performance. Now, this time, the solution is actually available in 3 different currencies, depending on the client needs, either US dollars or pound sterling or Australian dollars. And this time the deposit is split into 2 portions. There's the quantum portion, which provides an enhanced fixed rate of return. And that portion matures after just 1 year. Now, the returns on that one vary depending on the currency of the deposit. As you can see, Australia dollars pay 2.5%. In sterling, it pays 2.25%, and in US dollars, it pays 2% fixed rate of interest on that portion. Now, if you compare that against a typical fixed rate bank account at the moment, a standard account will, in US dollars, for example, will probably be paying you around 0.3% if you're lucky. So Quantum Plus 30 is providing a very enhanced rate of return on that portion of the funds. Now, the other portion, and the one that's in some ways more interesting to me, is the plus portion. This portion is over a 5.5-year term. Like any kind of equity-based investment, we like to have a bit of a longer term over it to provide a chance for a market cycle to occur and growth to happen. And those returns are linked to the performance of stock market indices. The market each one is linked to depends on the currency of deposit. The reason for that is that we want to link the returns to asset prices relevant to that currency to try and maintain a link between inflation rates and potential returns on the product. Now, depending on the currency of the product, this portion will provide either 60% of the growth in the market, or for Australian dollar deposits, 80% of the growth in that stock market index. Now, importantly, again, and just to re-emphasize, if the worst should happen and actually stock markets fall, well, the deposit amounts are kept protected when they're held in security. So it's a great backstop there for investors to rely on. These products can be a great way and a very simple way of getting a diversified market exposure in a safe way, and for a relatively low initial deposit amount. So we designed these products really to be as accessible as possible. The minimum being for Quantum Plus 30 being £10,000 or $15,000 or 15,000 Australian dollars. And the minimum for ESG being $15,000. So just to reiterate, we're trying to provide straightforward solutions, transparent, straightforward solutions to give investors access to international markets and have the potential at least to keep up with inflation. But in these troubling times, we're trying to do it in a very risk-controlled way. So thank you very much for your time this morning. And I will now hand back to Eric for questions and answers. Thank you.
Thank you both, Daniel and Chris. It seems uncertainty is the name of the game for us, but at least, Chris, you showed us some solutions that can protect us against these unforeseen movements in the markets. So we've got a bit of time left to cover a few questions. So I think let's get straight into it. So Daniel, I think this is quite an interesting one that I'm going to pose to you. So it reads, to what extent do cryptocurrencies negate effects of sanctions around Russia? Do you have a view on that?
Thank you, Eric. Look, I think they do. And I think that, the crypto, and I'm no expert on cryptocurrencies, but I want to say that, cryptocurrencies have been, from a regulatory point of view, it's been a bit like the Wild West over the last number of years as they've gained in traction. And I do think that the digital currency and the ability of using digital currency to move cash around the world is certainly a potential sanctions busting aspect of the new era in which we live. So I suppose the question is, to what degree will further regulation be slapped on Bitcoin and the crypto market in general to avoid this in future? And I would say there probably will be in future. So I'm also somewhat wary of crypto under these particular circumstances. I'm not wary of the technology behind it, and I think the blockchain technology is going to be probably the acceptable means of moving cash in the years to come. But as an investment vehicle, I think I would be a little wary specifically of crypto at this particular point in time. It's interesting to see, Eric, just on an investment point of view, that the gold market has certainly outperformed the crypto market over the course of the last few weeks or so. Perhaps some would say it's about time that gold actually made a move, given its somewhat stagnant performance, but it has actually moved. And with gold, you would have had at least a decent return on investment as opposed to watching and perhaps having sleepless nights about crypto.
Great, thanks for that input, Daniel. Maybe whilst you are there and unmuted, I've got another one for you linked to Russia. So what are your views around specifically links between South Africa and Russia with the situation at the moment?
Yeah, I think it's a very sensitive issue in South Africa. I don't think you need any prizes for guessing that the historic relations between the ANC and the old Soviet Union, those relations are very, very sound. The camaraderie as a result of support for the liberation struggle clearly has kept both the ANC and Moscow relatively aligned at the hip. And I think it's a very difficult alliance to break in any meaningful way. So one has to, I suppose, understand the historic linkages that is. It's not linkages about trade. I mean, South African trade with Russia is relatively small. Russian investments in South Africa, relatively small. It really, to me, is an emotional or historical linkage. And that has meant that South Africa has had to play, walk a tightrope on this particular issue. The tightrope is all very well. But I think, as Chris has correctly identified, ESG as being an important component of investments going forward. So ultimately will be one's position vis-a-vis Russia, a potential future Cold War, and the ethical dilemmas that one faces around this particular conflict. And South Africa could very well be drawn into this. The Western family of nations are already, and just in the last 2 days, we've seen pushback from the United States and from Germany on South Africa's public statements on this sort of sitting on the fence view that they've taken. I don't think it does South Africa any good at all to have this two-faced approach. It can prevent US investment dollars coming into South Africa as a result. And South Africa needs every single penny it can get from the broader investment community. So our loyalty to the Friends of the Liberation Struggle really also needs to know a limit, or needs to have a limit on it. If your friends do something bad, I suspect you should be able to criticize them as well. Otherwise, you're not a good friend. And I think South Africa have to wake up and smell the roses on that issue.
Great, thanks for that, Daniel. So I'll move over to Chris. So Chris, I know you spoke to us about capital protected products, but I think the question is more wider than that. So will my capital be safe if I invested in Isle of Man or Jersey as examples? So maybe you can elaborate on that for us, please.
The first, as I mentioned already, is the products themselves have the capital protection as absolute cornerstone of what they provide. So provided you hold the funds in the deposit till maturity, they're 100% capital protected. So the market can fall 80%. Just plucking figures out the air, and those funds are still safe. There's no lower amount there where it suddenly become at risk. The great thing about these particular solutions I've been talking about this morning are they both actually, the way we structure them are as deposits. So what that means is, from a regulatory standpoint, they're viewed in the same way as any other bank account. So a fixed rate bank account, or your current account, for example. Now, the benefit of that is that because the regulator views them as bank accounts, the only difference being the interest earned is linked to the performance of a stock market rather than a fixed rate of return. Because they're viewed as the same, actually the regulator actually then includes them in the depositor compensation scheme. So if anything should ever happen to Standard Bank International, for example, Standard Bank Isle of Man, for example, then actually the regulator stands behind deposits as well. There are limits within that range. I think it's 50,000 sterling equivalent for a sole account, or 100,000 for a joint account. But actually, the regulator stands behind it as yet another layer of defence as well. So it's fairly all-encompassing.
Great, thanks for that, Chris. I think the next two questions are separate but linked together, so I'll read both and maybe just get a view on these. The first one says, in case of death, would one need an offshore executor to help wind up the foreign portion of the estate, i.e. Quantum Plus or ESG? And then the next one says, for these UK investments, would one need a will in the UK to cover these investments, or would a South African will be sufficient? So maybe I'll just touch on that. So for any South African, if you have a will, that should suffice. However, the moment you diversify across borders and have money in another jurisdiction, you should ensure that your will states that it covers your worldwide assets. A lot of wills by default only talk about your South African assets, and then you might land into a bit of trouble in the offshore space. So please make sure that your will is up to date and that it has that statement in there to say worldwide assets. And I think that is the main point here that we want to bring across around, making sure that your estate is in order in the unfortunate event of death. Chris, I'll just move back to you. There's another one for you that's a bit more product related. So what are the charges involved in these products that you have spoken about?
Yeah, okay, thanks for that. So as I mentioned already, we try and build these products to be as straightforward and transparent as we possibly can. So to that end, actually, we don't charge any ongoing management fees, for example, during the life of the product. Any fees that we pay, so we do pay advisors, for example. If an advisor refers a product or gives advice on a product, we will pay a commission to advisors. However, what we pay them is built into the product terms already. So when we're factoring in how much it's going to cost us to provide this product, we already factor that in. And what that means is if a client deposits, let's say £10,000 into the product, well, actually a full investment of that full £10,000 actually goes into the product. We don't hive off any charges and then the residual goes in, and there are no ongoing charges on there either. So it's very, very simple, very straightforward.
Great, thanks for that, Chris. Daniel, I think there's another one for you here. I know you had that slide on around the currencies around the world, and South Africa kind of fell around number 5 on that list. But what is your view around the rand specifically against hard currencies, and where do you see us moving with the rand the short term?
Yeah, look, I learned a long time ago, whatever I say about the rand will probably be proven wrong the moment I say it. So I'm very wary about making calls on the rand. My own view is that the rand still, though, has got room to soften from the levels that it's at currently. And I do think that obviously a prudent exposure to offshore or to foreign currency, be it US dollars or euro or whatever it might be, remains, I think, important for South African investors. You're never going to time it perfectly in terms of choosing the right moment, but clearly if you can incrementally siphon off rands into foreign currency-based investments, I still believe that will be an important part of the diversification of your portfolio. We are going to be buffeted here, as I've indicated, by the potential of rising interest rates, depending on the inflation conundrum that faces us here. That could weaken the rand even further. And certainly in times of a major global crisis, and if this issue does escalate, we may well see further dollar strength, which also then inversely will weaken the South African rand. So, but the position is so murky at the moment. Again, it will also depend largely on the US interest rate cycles and whether these 4 predicted, at least for this coming year, whether they are accelerated as a result of the Ukraine crisis, or whether in fact they are decelerated as a result of economic pressures from these rising commodities and a softer business environment. So, my own view, and it's my personal view, is that a diversification offshore is essential to provide an additional bulwark against the vagaries of our currency, particularly in the light of ongoing political uncertainties in South Africa going forward.
Great, thanks for that, Daniel. And I think that links in nicely. I think we have time for 1 or 2 quick questions. Someone asked around how much do you, as a South African citizen, need to have offshore? So, I mean, from my perspective, we've seen a lot of research papers on this, and everybody's situation is different. So the first bit of advice would be speak to your broker and discuss your objectives around what you want to achieve. And then we've seen a variety. Some people say 30%, some say up to 50%. But again, it all depends on your own personal situation and, what you want to achieve over the medium to long term. So just want to move on to a couple of last points quickly, and then I'm sure we're going to be out of time. So Chris, do you maybe just want to cover off the tax aspect on the products? So if I invest into your Quantum Plus, what would the tax treatment be for myself?
Yeah, sure. So as I mentioned, these are deposit products, so that provides many advantages, such as the protection surrounding the products. And I've just seen a question that came through asking about whether that protection is in rand-based or the deposit currency. Just to be clear, it is based in the currency of the deposits. That protection is provided. Now, because it's deposit, it is more than likely that so it's paid on a gross basis offshore, but then tax obviously should be declared locally. And just to put up front here, I'm not a tax advisor. I'm just talking about a likely tax treatment. So it should be declared locally within South Africa. Because it's a deposit, we expect that it will be treated as interest income. However, there are various life insurance companies, etc., and platforms that are available, and you can speak with your broker about that may assist in the treatment and management of that.
Great, thanks for that, Chris. And then I'll just touch on the very last one, and then we will be out of time. Someone asked a question around how they get their money offshore, and that maybe touches on what you just said, Chris. So all the products we've discussed here today are hard currency products. So as a South African, we are governed under exchange control, and you have two allowances. So one would be your single discretionary allowance, which allows you as individual to send out 1 million rand out of the country every year without a tax clearance. Now, it's quite important to understand that if you do externalize 1 million rands, but you also go to New York for a holiday and you spend some of your rands that are still in South Africa, then you would actually be in breach of those regulations. On top of that, each individual will have a foreign investment allowance as well. For that, you do need to apply for a tax clearance. SARS allows you to do that through e-filing, and you can send a further 10 million rands out of the country every year as long as you have your tax clearance certificate. And then by way of methods, there are several ways how you can actually physically get that done. You can visit a branch where there's a bureau de change or a forex outlet. You can actually do it on Standard Bank's mobile app, as example, internet banking. So there are lots of methods of doing that. Saying that, we are just about to finish. So I would just like to extend my thanks to Daniel and Chris for having some time with us today. Really appreciate your insights and the information you shared with us today. I would just like to reiterate that we will in due course, in a few days' time, share the recording. We will answer the questions we didn't get to, but really want to thank you for your time listening to us today. And please, if you have any further questions, don't hesitate to reach out to your broker or get in touch with us or visit our webpage to get in touch with us. So I wish you all a lovely day further, and thanks so much for all your time. Thank you.